I haven't got that comment from Mr. Ambani. Nothing has come so far officially on the Reliance Jio. So that's a fine print which we are also looking at it. The outstanding debt, that is something which we need to also look at, that over the years, because of the Reliance Jio project, the total debt on Reliance's balance sheet has gone higher. I mean, a couple of years ago, Reliance was a net cash company. Now that huge debt also has kicked into Reliance's balance sheet. Okay, let's also connect with Mayuresh Joshi for his initial take. And Mayuresh, what's your sense? I mean, based on these numbers, a pop-up for the stock tomorrow morning?
Possibly, Nikunj. Yes, petchem margins probably a beat, and the expectations was always there that petchem will perform quite well in this quarter. Refining margins more in line with expectations because the kind of rebound that you probably saw in August, September in terms of Singapore GRMs, that would have reflected positively in terms of how Reliance's GRMs would have panned out. So yes, I think the petchem margin has been a beat. The refining margins more or less in line with estimates. The bottom line has exceeded estimates. So I think one really needs to see the other income figure and whether any extraordinaries are there. But yes, I think on the EBIT front, I think it has been a beat for Reliance in this quarter.
Sanjeev Pandey also joins us with his analysis. And Sanjeev, what is your sense? I mean, do you think it's all about petrochemicals this quarter?
Yeah, certainly. Well, I'm not able to look at the detailed numbers, but what I understood from the discussion is that petchem is definitely given a substantially better number than what we were expecting, and the GRM seems to be 10.25, 10.3 range that we had estimated. So that's in line.
With Sandeep, apparently.
Right. Mayuresh, actually other income component has come in at 2200 crore versus expectations of 2000 crore. Mayuresh, I would like your reaction on this other income number of 2200 crore.
So again, Ajay, I think largely you might estimate that to come around these figures itself, but what the street is probably looking at apart from other income is the core performance, because Reliance, petchem and refining now contribute almost 60% of the bottom line, and these businesses are going to do well because the kind of capex that they've done in these core businesses and the expectations of capacity is coming on stream on the refining front. The petcoke gasification expected to come through the off-gas cracker for petchem, and even on the polyester front, I think the PTA plants have started functioning since the commissioning has taken place. So I think the spreads over there should be quite encouraging as well. So I think the other income number more or less expected to be around these lines, but the bottom line performance because of the two core businesses is something that the street will be watchful for.
Right. Sanjeev, what are your thoughts on this petchem percentage of the margin, the EBIT margin at 16.2%? They've been coming higher from 11.5 odd last 3-4 quarters, now coming at 16.2. How much more further expansion scope do you see in this particular reading?
Frankly, it's very difficult to say. Eventually you have to accept that fact. That it's it depends on the dynamics of the commodity prices and eventually what price you are selling your products. So obviously the input cost has been bringing in, and because of that the company has been benefited. Obviously there is going to be a limit to it, but till this point of time it is being on the surprise side, so we are happy being surprised only. Difficult to say how much percentage it could go up to, but a fairly decent could be around 14-15% should be a sustainable range, but beyond that it's sheer surprise.
Vishal, what we are discussing today are the petrochemical margins and the refining margins, or the crack spreads, but next quarter we could be discussing Reliance Jio, the launch of Reliance Jio and implications of that on the income side and on the depreciation side. Vishal, are you there?
Yes.
I'm there. See, you will have to look at it as a commercial launch which we have signed from first quarter. So, no revenue. Billing starts from 1st of January. So, would Jio not going to impact in the third quarter? Because impact will be visible to 2017, not this way. And my personal take on refining margins for the current quarter will be superior to current quarter.
There's a bit of an audio problem there. So let's go back to the graphic once again. I just want to point out the trend for Reliance Industries. It's the trend which matters. I mean, what they managed to do in this quarter, what they managed to do in the last quarter. So what's been the trend there? Expectations versus delivery. You know, it's all about expectation management if you're a listed company. Q4 FY16 in line, beat. So the trajectory for Reliance now simply seems to be that they are on course to come out with numbers which are market beating in nature. And Mayuresh, I want to come back to that other where I lost Sushil there, is that today we are discussing the chemical business, the petrochemical business, the refining business, little bit of retail. But next quarter it will be about Reliance Jio. The commercial launch is expected in December, which is a month from now. Okay, I got a comment from Mukesh Ambani. The company has achieved outstanding second quarter numbers with strong refining business performance. Refining business sustained high profitability in a tough environment, highlighting our exceptional refining assets, dynamic response to market trends and robust operations. So clearly he's attributing the success to the refining business, and Ajay, Mr. Ambani is attributing the success to the refining business, but the surprise actually has come in the petrochemical business.
Because what I understand from what you were reading out, Mr. Ambani is trying to say that despite a very tough environment on the refining side, they did not do as bad as how the sector was, or perhaps some of the peers were, and they tried to protect that from the refining side. In absolute terms, that continues to remain the biggest base. So the the biggest contribution to the earnings comes from that. Then of course comes petchem. So percentage wise, clearly petchem has expanded, but refining has not done as bad as perhaps the street are fearing out. Probably that's the message coming out of their communication.
Sushil, in the month of September and early part of October, the GRMs or Singapore GRMs have gone up. So should we actually focus on that aspect? I mean, today what we are discussing are numbers which captures the GRM uptick till September end. This is end of October. So surely GRMs have expanded in the month of October, and you think that is the story which we need to focus on?
See, there is a imbalance in the fuel market on a global basis because of some refinery realignment which is happening in Russia and some other parts of the world. So the refining margins in the third quarter as of today seems to be on a better note compared to Q2. And the throughput and the oil volatility also will have a benefit because the market would have expanded. Inventory gain should be visible in the current quarter as of today. And busy fuel season for the West normally is in the winter. So the margin should be very good on the third quarter, except they're taking some shutdown, if I remember, FCC cracker right now. So that we'll have to estimate based on throughput. But what I would watch out is Reliance entire capex is being rolled out over a period of next 6 months to 12 months. So quarter on quarter, what kind of throughput Reliance is able to achieve on petrochemical business, and what is the refinery throughput for the current quarter, that we need to watch out. So if we get that numbers, then only we'll be able to assess, because the entire capex benefit so far has not come through, and that is likely to emerge from this now to next 18 months. And quarter on quarter, people can get surprised based on what is the value addition projects which they are doing.
Right. Okay, let's talk about the valuation of the stock. We discussed that they put up a brave show, and in fact better than what the estimates were, and that's why perhaps the stock was very flat and no activity going into the numbers. But let's talk about the numbers from here on. Mayuresh, what is your call based on this kind of a performance? How do you see the valuations of Reliance Industries on a 1 year forward basis? It is slightly at a discount to the overall sector average.
Again, Ajay, I think it has been doing that for the past so many quarters, and even if you look at the cash flow yields for Reliance, I think they've been exceptionally good. But the markets probably are giving some amount of some headwinds in relation to how the earnings prospects for Reliance will pan out. But I've always been maintaining this, that post FY18, I think that our numbers will start appearing much better. And even on the telecom part, I think the kind of capex that they've run, $21 billion so far, further capex probably can be expected. So I think analysts are not penciling in or pegging in any estimates from the telecom business, at least for this fiscal year. But I think how the subscriber base grows, they've already booked some from 16 million odd subscribers during their pilot runs, how this base expands and how that can be correlated to the overall business is something to be seen. On the retail business itself, I think it's a very small component in terms of contribution to bottom line, but it has seen positive trends. And shale and again the E&P business, I think it's largely been written off in terms of the losses, both in terms of fall in crude prices as well as the domestic gas prices, which have stayed exceedingly low, and the losses on that front might very well continue as the production from KGD6 is still expected to be at muted levels. So largely I think with commissioning of new facilities, the petchem and refining business should hold up for Reliance. I think telecom should start picking up. Again, I think no estimates taken into account for FY17. I think largely analysts are also of the belief that the losses will probably run into FY18. But as the subscriber base grows and as the majority of these customers start contributing in terms of core ARPUs, the numbers post FY18 I think will be very interesting to watch out for, specifically on the telecom part. So yes, I think interesting times for Reliance in the coming few quarters.
Right. Gentlemen, stay with us. Let's also get a global opinion. Vandana Hari joins us on the phone line from Singapore. Vandana, your thoughts on how refining margins, I'm just taking Reliance results as a reference point because you track that space closely. How is the Asia refining sector doing right now? Singapore margins fell all the way to $3 and have rebound now. Vandana? Okay, we'll just get back to Vandana. Azleen is also joining us. Azleen, can you? Okay, is Vandana back? Can you connect with her once again? Okay, we'll try and connect with that. Sanjeev, let me come to you. In the meantime, we'll dial her again. I was wanting a reaction on the stock price. Mayuresh said that we do not need to work the numbers very aggressively right now. What are your own thoughts with this kind of performance? Would you rework your numbers, take a relook at it, and at 9.5, 10 times when you forward, how do you see the stock?
In terms of estimates you're talking about, or in terms of price target stuff, what I believe is that basically if you really look at the business like this, refining side of business and petchem side of the business, the market is really surprised, but at the same time market is not really sure about the telecom business, though there are initial indications of the very aggressive and very aggressive kind of pricing strategy that are going to adapt, and the number of volumes that they could attract would be surprise on the positive side. But on the bottom line side, I think market is still hovering around or wondering how things could shape out. So based on that, that seems to be some apprehension still regarding the valuation and the bottom line contribution from the telecom business, because a huge part of the capex has been done in that side. Keeping that aside, the current downstream business seems to be on the robust front. So I think we will retain our outlook because FY17 and 18 would be the 2 years where the downstream capex will start reflecting its purely full year numbers in terms of capex addition that has happened. So we'll retain our positive stance on that based on the evaluation, because the valuation is already factoring the concerns within that capital allocation towards Geo.
My limited point is that Reliance, if I look at the 2-year picture, 3-year picture, is an underperformer. Will these numbers make Reliance an outperformer? The answer to that is no. Now tomorrow morning, yes, Reliance will align with the numbers. Reliance of late has, in last 15-20 days, has managed to outperform the market. It's in heavyweight. So the technical adjustment for Reliance would be there tomorrow. But the story for Reliance, the script of how the stock would move now will change dramatically. Reliance Jio is not going to be an easy thing for markets to understand and digest. Once you launch, there will be a depreciation charge which will have impact on net profitability. Reliance was a zero debt company, all cash company couple of years ago. That picture has changed. So there are a lot of imponderables which Reliance will have to, which Reliance shareholders, they need to really bring into the stride, so to speak. And Sushil, that's my broader question. The Reliance of 2016 will be Reliance of 2017 will be dramatically different from Reliance of 2016? And do you think markets will find it slightly difficult to understand and calculate and project what the Reliance of 2017 and beyond could be?
I think Nikunj, the uneasy part of predicting Reliance's future is over, because Jio subscriber base of 16 million, likely to move towards 30 and 40 million, would give you a predictable revenue run rate on a basis of estimate of 40-50,000 crores. And if company, let's assume by 17 December at that run rate, the interest cover would be definitely visible out of the revenues in Jio. But the part which you need to keep in mind, the core business, which is throwing a EBITDA margin today around 45-47,000 crores, will have more than 20-25% growth on year. So FY17, FY18 and FY19 will have 20% growth on EBITDA margins minimum on absolute total number, and the core petrochemical business will be supporting the growth part as much as what people have. The street is definitely obsessed because so much of capex has gone in Jio, and does it become productive? My personal estimate is 40-50,000 crores of revenue run rate if Jio is able to show on an indicative basis 3-4 quarters later. I am sure that the interest burden and some part of depreciation will be able to cover. Till December, I don't see any interest burden being.
There's some important comments from Reliance which needs to be which we need to revisit, and one I'm coming right to you once I read out those flashes, and it talks about Reliance's analysis of oil. They feel the outlook for oil in the medium term is positive, and the fact that product demand is coming back, that is an indication that inventory dial downs have stopped, inventory restocking has started. And typically when the cycle changes, destocking stops, restocking starts. When restocking starts, the product demand is going to be very large, which is what we saw, I think, in the petrochemical business. Panda, you may want to come in on that point. Reliance is indicating that a new cycle or a fresh cycle actually started in the oil market and in the petrochemical market.
Yeah, I think the jury is still out on whether the stocks are actually coming down globally or not. In fact, some comments earlier this week at an oil conference in London, the Saudi oil minister and the ExxonMobil CEO differed quite a bit. Rex Tillerson, the ExxonMobil CEO, was saying that the outlook for crude prices is not too good because there is plenty of stocks, product stocks and crude stocks globally. Now, as you just mentioned, refining is very, very cyclical. So when margins are good, typically all refiners start increasing their operating rates, and as a result you get much more product in the market, which in turn brings down refining margins. Now, this year the refining margins have fluctuated quite a bit. So if you look at the Singapore GRMs, they have fluctuated anywhere between just under $4 and just under $7 a barrel. They have been a little bit better this month, and generally going into the winter demand season, they should be better. But having said that, the other thing you need to keep in view also is China has been a major disruptive factor this year. The small refineries in China called teapot refineries, typically 10 to 100,000 barrels per day. They have gotten a fresh boost with the government giving them permission to import crude and export products, and they have put a lot of refined product out into the market as well. So overall, the crude glut story of the past 2 years has also been changing a little bit into a products glut story. Now that obviously means not a very good outlook for refining margins.
Mayuresh, the outlook for refining margin according to Vandana may not be that rosy, and that is also getting reflected in Reliance's GRMs. They may be above street estimates, but directionally, will that change dramatically in this kind of a global environment where supply is more and demand is less? That's questionable.
No, absolutely agree with Vandana in terms of what the end product use can be with refining margins going up. And the second point specifically in terms of refining itself, Nikunj, the two key components, gasoline and fuel oil, you've probably seen increase in both. And fuel oil specifically because you've been shut down in production capacities in Russia and Venezuela. Because of that, I think almost 30% of the output probably is not expected to come through, and the huge spike that you've probably seen. So the Singapore GRMs have probably bumped up because of these reasons. margins. But Reliance GRMs probably do not take into account fuel oil. So to that extent itself, the outperformance because of fuel oil going up might not get reflected in Singapore GRMs. And also one point to be noted is the narrowing gap between diesel and fuel oils. I think that will also restrict probably the expansion of GRMs in a significant manner. So yes, I think volatility will continue in terms of how the GRMs are expected to move, specifically with end user prices being extremely unstable over the next few months. But again, I think with increase in fuel oil prices, I think that clear-cut demarcation in terms of the pass-through for Reliance GRMs will not probably come through.
Right. Sanjeev, how are you looking at the demand environment, and also not only the margins have expanded, the volumes for the petchem have also been pretty healthy. So because it's more of a domestic business, how are you assessing the demand environment for petchem products and the volume growth outlook in this segment for Reliance?
What we gather our information from various sources is that the demand from the domestic sides remains stable, and I think because of the a lot of usage, especially across the products that they are offering, with the domestic activity continuously in a decent growth rate, seems to be in a fairly stable rate outlook.
Okay, Sushil, I go back to the very basic question. Reliance on a 3-year basis has been an underperforming stock. On a 1-month basis, 2-month basis, it has been a market performer or a slight bit of an outperformer. Will these numbers ensure that Reliance now falls in the outperforming groove?
March 17 and March 18 basis, I am quite bullish on Reliance investors to make a handsome gain, outbeating the market.
Mayuresh, would you like to buy Reliance in your portfolio, and would you stack Reliance right at the top of the heap?
No, again, I think it is one stock which is largely underperformed for all the reasons probably mentioned over the past so many years. But going forward, as I said, I think with the core businesses improving, and even on the telecom part, if you assume the subscriber base to increase at a multifold rate, and even if you assume FIT numbers to be soft in terms of added depreciation and interest costs, I think the telecom business should also meaningfully start contributing 2 years hence. I think too difficult or too early to probably say at this point of time what the exact quantification will be. But yes, I think I maintain a positive outlook for Reliance over the next 2 years.
Sanjeev, Reliance, yes, no, if yes, how much in next 12 months?
I think the valuations are in favor of Reliance, and obviously earnings momentum, especially from the downstream business upcycle. So considering these two things, I still think that it's a buy, maybe around 15% kind of upside I can see from this level, even from this level.
Vanna, we'll keep the stock market angle aside, but I want to understand the global market environment from you. GRMs, I think, is the mainstay for Reliance, and GRM is where your opinion is that we should not get excited. But Vanna, my basic question to you is that why Reliance historically has always enjoyed margins which are at least 15 to 20% premium than what the Singapore GRMs are?
Yeah, there's a few factors for that. So first of all, Reliance is a highly sophisticated refinery, so which is when you measure as a Nelson complexity index, it's the most complex refinery probably anywhere in the world. They also have economies of scale. It's a massive refinery. So what it is capable of doing essentially is taking the dirtiest of crudes. These are typically heavy crudes, sour, high sulfur crudes, very acidic crudes, which are typically available at steep discounts to your sweeter crudes and lighter crudes. So it's able to take these and it's able to transform them into the most clean products, Euro 5 and so on. So essentially a margin for a refiner is the difference between, how much of a discount, how cheaply can you get your crude and how high can you sell a refined product. So, and of course it exports a substantial part of its production as well. So, traditionally when in India gas oil had subsidies, Reliance didn't suffer as much because of that as compared with its state-owned peers. So the combination of factors, it's very optimized to it gets the cheapest of crudes.
Okay, Vanna, we'll have to leave it there. Okay, ET now verdict, it'll just come up on your screen. It's a green for Reliance, which means tomorrow morning you will see a gap up start. Reliance is a heavyweight. IT has not delivered, Reliance has delivered. So when Reliance delivers, Nifty, at least the imbalances in the Nifty will be taken care of. My sense is that this will be a short-term booster for Reliance. The part of uncertainty is behind us after the Reliance Jio launch. The numbers are out in the open. Valuations are attractive for Reliance, but when the global demand supply imbalances are real, until the time markets are not confident of restocking of a new inventory cycle for a company which gets 1/3 of its revenue or 1/3 of its projected revenue from the refining business, followed by the petrochemical business and the E&P business, because telecom business will only kick in the second half of FY18, and which would be disruptive in nature, and there would be impact of depreciation. There could be a case for Reliance at best remain a market performer. Now when I say market performer, Reliance on a 3-year basis has been an underperformer. So for an underperformer to become market performer for a heavyweight, I think that's a change in tide. That's my sense. Okay, gentlemen, appreciate your time. Vandana, thank you as well for joining us. That was our special coverage on Reliance numbers. Fasten your seatbelts for a gap up start. Numbers are strong, and I think markets will give it a thumbs up at 9:15 tomorrow morning. Thank you for tuning in, and thank you for watching India's #1 business channel.